Money FM 89.3, best of breakfast. The U.S. Market Update with Money FM 89.3.
Good morning. Welcome to the U.S. Markets Wrap with me, Ryan Huang. We've got green on the screen as stocks rallied. The S&P 500 clawing back more of the rout it saw since late February that took the benchmark briefly into correction territory. And this as the Federal Reserve forecasts that it's going to be cutting interest rates 2 more times this year. The Dow Jones Industrial Average climbed 0.9%, the S&P 500 jumped 1.1%, and the Nasdaq Composite advanced 1.4%. For more insights, we are joined by Ryan Detrick. He is the Chief Market Strategist at Carson Group. Ryan, good morning. Always great to have you on the show.
Like I've always said, it's always nice to talk to another Ryan. So thank you for having me back. I appreciate it.
Yeah, back at you, Ryan. All right, let's talk about what is on the table front and center, which is the FOMC meeting. So they've kept rates at a range of 4.25 to 4.5%. And this decision was widely expected. Walk us through the thinking here, because in the backdrop, we've got a couple of things playing out. You've got the tariffs, you've got the uncertainty, you've got the top of recession. To what degree were you expecting this as well as the 2 rate cuts they've been tabling?
Yeah, all in all, I think they just didn't rock the boat very much. There was worry they might come off hawkish, right, implying they're worried about inflation, maybe going to hike, or not hike rates, that's the wrong way to put it, but worried about inflation, maybe push back on, okay, the tariffs, could those be more inflationary? It really seemed like Powell wasn't overly worried about that. He said, yeah, there's some kinks in the U.S. economy, but it wasn't like the economy's slowing down massively. So, again, I'm always a how does the market react type of person. Well, U.S. stocks, like you just mentioned, had a really, really good day. And the 10-year yield, honestly, yields across the curve, they all moved lower. So the bottom line, the market took this kind of dovishly, and you know what? That was a nice thing to kind of keep this bounce we've had going in the U.S. The last couple of days.
Yeah, so it does look like investors are shaking off any concerns of what might come. And Jerome Powell also signaled that inflation has started to move up. Has that been your observation as well?
It has been. I mean, Powell, he's the one who drives the bus. I think it's really important because there's all these different Fed members, and we hear about them, we see their opinions. I mean, he's the bus driver, so he's going in charge. So his voice matters. And again, I just think it was more of a relief that he didn't come off hawkish. Of course, today we get the dot plots. It comes out quarterly. Again, 2 cuts still likely, so nothing too crazy out of the blue there. But during the Q&A, I mean, he pushed back. It's like the reporters were wanting him to say, tariffs are going to be inflationary. And he just didn't want to say that because, there is a lot of uncertainty clearly with the tariffs and when are they going to take place? Well, April 2nd is when a lot of them are going to go and play. But will they be there? Won't they be there? But overall, I think he painted a still fairly overall solid picture. He even said the labor market was pretty solid. And we're seeing some kinks in the labor market. So I think that was a relief as well.
Yeah, so he's pretty much doing that balancing act, just giving himself wiggle room to maneuver, so to speak.
Yes.
All right. Talking about what else has been on the table for the Fed, they've marked down their forecasts for growth this year. How do you see this playing out for companies when they do their next earnings season and next few quarters?
Yeah, again, not a huge surprise because we've been seeing some kinks in the armor in the U.S. economy, but let's be clear, this is more of a slowdown. We call it a growth scare. Is there a growth scare? Maybe we're kind of repricing, some of the potential worries. I mean, some of the soft data here in the U.S., how do you feel? Sentiment polls are kind of low. Then we had the retail sales numbers earlier this week. They were kind of wishy-washy. You could find some good, some bad in there. Truth is usually somewhere in the middle. But again, the reality is the economy is slowing down a little bit. And I would think our best guess is more just a early slowdown in a year. First quarter in the U.S. historically has been kind of one of the weaker quarters from an economic growth point of view. So we could be seeing that once again. We don't see a recession. So, yes, earnings growth might take a little bit of a hit. Consumption might take a little bit of a hit. That's kind of why we're repricing so much. That's why we just had a 10% correction here in the United States and more in some of the technology stocks and other areas as we reprice some of those worries. But reality, again, is there's still no recession coming in our view.
Okay, so no recession likely, but we do have that correction which helped to pull back prices. Does this mean it's a chance to buy in on the dips?
We'd say so, yeah. The thing to remember, United States, the S&P 500 did not have a 10% correction last year. It had one into the end of 23. On average, since 1928, you see 10% correction. So we kind of figured, you know what, we're probably due for some volatility. Clearly, that took place. Now, the other thing for listeners to know, first quarter in a post-election year like we are now, it's usually pretty weak. First quarter after a 20% gain the year before is usually pretty weak. The last 20 years, the S&P 500 has been negative year-to-date as of the middle of March. Then it bottoms and rallies. Well, once again, we kind of had a mid-March bottom. We'll see if it keeps going. I think it could. I think it very well can. And this is kind of playing out just to shake off some of the over-the-top optimism that we were seeing just 2 or 3 months ago. Everybody thought everything was great 2 or 3 months ago. Now everybody's extremely worried and bearish. As usual, the truth is somewhere in the middle. We think this is an opportunity for investors to buy some good companies on the cheap.
So volatility is the name of the game these days. And talk about buying companies on the cheap. What is on your shopping list?
Yeah, one thing along those lines, we like to say volatility is the toll we pay to invest, and that's just what we're seeing. Now, getting to it, what we're doing with the money that we run on the Carson team, we work with financial advisors and manage a lot of money. We're saying be diversified, right? And again, what does that mean? Well, we've been very overweight the United States for the last couple of years. It's done well, right? But as this cycle ages, we're looking around. We've got some developed international. We've got some treasuries. We've got some gold actually in our portfolios, a little bit of emerging markets as well. So, other parts of the world are doing really well. Obviously, I'm talking to you in Singapore. You know this. A lot of other parts are doing well. Here in the U.S., everyone just focuses on the U.S., and that's fine. But a lot of other parts are doing well. That's why you're diversified. But specifically in the U.S., we like industrials, we like financials, and honestly, some of the low volatility names, because we haven't really liked the Mag 7 for a while. There's just some issues there, kind of overpriced, potentially overpriced, high bar. And then when those things kind of fall apart, we see what's happened, obviously, with the underperformance. So those low volatility names are some other ones we think offer some good upside potential the rest of this year.
Yeah, I know you say diversify. What are you staying away from? Are you looking at maybe reducing your exposure to retail, which has been a bit soft in terms of the outlook?
Well, not yet. We've been more neutral, consumer discretionary in general. We're still underweight areas like utilities and staples, some of those more defensive, I guess, by nature areas are what we've been. Also, when it comes to fixed income, we've been kind of on the shorter end of the curve, meaning if interest rates would go up, they won't do as well. But now we think interest rates are going to go lower. We think the Fed's going to probably cut more than 2 times, by the way. I know that's what they said today. So we're looking at using maybe some longer-term bonds in a portfolio rerun. Like I said, we've got some treasuries for the first time. So we'd say, maybe avoid the shorter end of the curve if rates go lower. But the key concept, at least, from a U.S. investor point of view, what we're preaching, be diversified. Lots of other parts of the globe are doing really well. That's perfectly normal, and it's really healthy.
Yeah, I'm hearing a lot about how Europe is starting to pick up again. They are calling it MEGA, make Europe great again, especially with Germany unlocking their reserves to spend more. Is that a place you're looking at more closely these days?
It sure is. I mean, Germany, I think up 20% on the year. Now, that's a historic move. But even, as of March 15th, if you look at the U.S. Versus EFA, that's the largest outperformance we've ever seen up to this point of the year. So the U.S. is probably going to play some catch-up, don't get me wrong. But when we look at what Germany just did a couple weeks ago, they brought out the bazooka, right? I mean, it did an incredible amount of stimulus from the defense point of view and then from the fiscal point of view. And those are things that really, one more comment on this, Germany's economy grew about 1% the last 6 years, okay? The U.S. economy grew like 12% just for just to show the difference there. But they need to stimulate some things. In Europe, the expectations were so – nobody wanted to touch Europe this time 3 months ago. Now a lot of people are interested in Europe. But again, I think that's a good part of the globe that's fairly cheap still after the bounce. And we think there's maybe some more to go as it pertains to EFA specifically.
All right, great snapshot of where the opportunities are in the markets right now. And we've been in conversation. Ryan Detrick, he is the Chief Market Strategist at the Carson Group. Ryan, always great chatting with you. Thanks for your time.
I appreciate it, Ryan, as well. Like I said, always nice talking to another Ryan, and have a great morning, and thanks for talking to me.
All right, looking forward to having you back again soon. Stay on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.